Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Chris Smith, portfolio manager of the Antero Peak Group at Artisan Partners, Michael Normyle, U.S. economist at Nasdaq, and Chris Dearborn and Max Cabasso, managing directors on the Nasdaq Market Intelligence Desk. They join us to discuss how the market is distinguishing its performance around earnings in 2024 relative to 2023. We'll also take a look at some outlook as well. It is great to have all of you with us, and Chris Smith, we'll start with you. I think that's what's interesting with 2024. We are now focusing on fundamentals and earnings and less so on what the Fed is doing, whether they're raising rates, cutting rates.
Yeah, I think last year was interesting. It was the lowest breadth the S&P's ever had, and it was about 15% of the market outperformed. So you had a really difficult year last year in terms of distinguishing from an earnings perspective what was going to outperform the market. This year, you're seeing earnings. Q1 was the best earnings season we've had in over 5 years for the S&P. You've seen a lot more breadth in terms of companies beating. And I think that's led to more breadth in the market and a lot more outperformance and the ability to outperform the S&P overall.
And Chris, this is something that we've been talking about on the desk week after week. We came into this year expecting 6 to 7 rate cuts, and we haven't gotten them, right? Maybe 1 or 2 this year, but the fact of the matter is, to Chris S's point, is that earnings have been, quite good, and it's starting to broaden out, and that's what you want to see.
The market's riding a 5-week winning streak coming into this week right now. You're up 70% on some of the indices for the month. We'll see what happens after the minutes released today, and we'll see what NVIDIA brings tonight. But the earnings across the board, you talk about the 7 and the 493. Michael get into that a little bit too. But when you look at the earnings projections, a lot of the companies that are being rewarded, it's not just whether they beat, it's the rhetoric that comes out afterwards with the guidance for the full year. And if they're not giving good guidance, if they're not satisfying the street, the reaction is negative. To sell the news despite the beat. And you're seeing that a lot more and more. And those that do miss and don't give good guidance, especially in the consumer spaces where I'm focused on, gets hit tremendously. You've got a number of companies, when we talked about the consumer space a little bit before with me here, anybody, if you sell a cup of coffee, or if you're at leisure, or if you're even at a dollar store, you're seeing significant hit there. And the question is then, where do you focus from there, right? The earnings itself is fantastic, but the backdrop is really kind of interesting because you've got a higher rate. The nominal rate's been higher for significantly longer. The rate cut differential is from 6 to maybe 1. They're pricing in right now, depending what happens now. I haven't seen it, but the Fed Fund futures this morning were pricing a September move of about 70%. We'll see if that holds true or not.
Yeah.
If not, a little kick after till November. But you're seeing consumer spending kind of pulling back a little bit. We'll get into the data a little bit.
Yeah.
And it's finally seeing that soft landing, maybe soft landing, no landing, Goldilocks perhaps here, in this type of mentality. If the consumer gets hurt and starts to pull back, retail sales finally started to pull back a little bit. Need to see some of that pullback. But you're seeing the companies have been talking about that well before the data even started.
Yeah, well, let's talk about that, Michael, for a moment here in terms of employment data. And one of the, to Chris's point, the consumer is still strong because people are employed for the most part that want to be working. That's what the data suggests anyway. What are you seeing? What are you hearing in terms of how companies are thinking about hiring?
Right. So on the whole, if you look at layoffs, that's really the clear point of strength where companies have been really reluctant to lay people off. So right now, the layoffs data, it's lower than it's been for the whole pre-COVID period back to 2000. But we have seen some softening in the labor market with hires slowing, quits slowing. So those are back to kind of like 2017, 2018 levels, which was a still good labor market, but of course not 21, 22 level labor market, or even 2019. And the real kind of weakness that we're starting to see come through is more with small businesses, where the NFIB survey, if you look at the hiring plans there, they're now the worst they've been since 2016. But these are really, really small businesses. So 90% of the companies surveyed by the NFIB have fewer than 20 employees. But that's still, companies that size are 25% of the private sector. So they're a big chunk of the economy. But on the flip side, we see big businesses actually doing better, where the Business Roundtable CEO survey, their hiring plans have picked up for 2 straight quarters. And those are basically the 200 biggest companies in the US. And so really big companies, they employ about 1/5 of all private sector jobs. So we have kind of a 2-speed labor market almost, where the small companies are looking a bit worse, the big companies are looking a bit better. So we might have a little bit of kind of muddling through a bit where that kind of push and pull is going on. But once those rate cuts come through, that's going to really help the small businesses, which are more rate sensitive. So hopefully we can kind of muddle through until the late part of the year, get some rate cuts, and that can help the small businesses pick up a little bit in the labor department.
Yeah. Max, let's pull in some charts here for a moment. What sector are you starting to see broaden out a bit more in terms of where some money is rotating in?
Yeah, utilities has kind of been the focus. They're the top performer year to date over the month. They're very close here to all-time highs we saw in 2022. We've talked about this sort of trade, for a few weeks now, playing off the AI cycle. Obviously, we have big earnings after the close, but that first trade was the tech, who's actually involved with it, and we've talked about it now again. How is it going to be powered? What's good? How are we going to fund all this? And you're starting to see it pick up in utilities with some of the energy. Anybody that's involved with nuclear or gas, powering these data centers that are going to be consuming so much to perform all the tasks that we're now hoping AI can do for us. So that second level trade has been big so far this year. You can see we're kind of sideways in Utes for a year. Obviously, they're a bit rate sensitive now, but they've really picked up. We still have a little bit of room to those all-time highs, but if we can get through there, I think Utes could continue to run. You're also getting dividend off of that, so utilities are definitely a big one to watch that have really performed well to start the year. Yeah,
Chris, and when we talk about breadth widening out here from an active versus passive perspective as it relates to portfolio management, does that help when you think about active? Is it better, in other words, for it to broaden out a bit?
Yeah, I think active management historically has about a 0.89 correlation to breadth in the market. So when breadth is really low, active underperforms. Mm-hmm. When breadth picks up, active really outperforms. So the last time we were at these breadth levels was right at the top of the dot-com bubble, and active had its worst 3-year stretch heading into that. And now what you're seeing is as breadth is kind of widening out, active is starting to outperform. Last year was the worst year for active management since 2000, and now you're starting to see that turn around here in 2024.
Right, so where is your team finding opportunities, as you think, outside of what's been driving the market?
Yeah, and I think, you made a good point. I think you're seeing the top of the market in large cap names. They're forecasted in Q1, they're gonna end up having double-digit earnings growth, and the forecast for Q2 and Q3 are very similar. So large companies across a variety of sectors like aerospace, power, utilities are a good opportunity out there with rates kind of peaking out here on the long end, which really is a big driver of utilities. You have rates kind of peaking out there, but you also have demand picking up for them. So you're seeing a lot of areas of the market pick up in terms of demand overall, and we're kind of staying clear of consumer. Mm-hmm. I agree. A lot of consumer companies in Q1 are talking down and saying they're seeing a slowing and a deterioration coming. So we're really looking at more infrastructure plays, industrial plays, areas like that in the market that sound really good right now.
Yeah, and to the point about being, wary of the consumer here, Michael, the data may show that inflation is, somewhat coming under control in certain segments of the data that they're looking at, but it still feels, at least anecdotally, that the consumer is not really feeling that good about the economy. I heard a survey this morning on CNBC that a majority of the people that were surveyed thought that we were in a recession, or that unemployment's as high as it's been in 50 years. The numbers say something very different. So that is anecdotal evidence that there's a big disconnect from what the consumer's thinking versus how economists and how we at the table are interpreting that data.
Right, I think that is probably just the accumulation of all this inflation that people have been dealing with for 2 years, 3 years now, and so things feel so much worse than they are because you've been getting wage gains, but they've all been eaten up by inflation. So you feel like you're kind of running in place in that sense. Mm-hmm. So it makes sense that people feel like the economy is not doing that great. If you're working hard, you're getting promotions, you're getting wage gains, whatever, but it doesn't improve your quality of life at all. So it makes sense that even though the unemployment rate is 3.9%, close to the lowest it's been since the late 1960s, that people feel like, I have a job, but I'm not getting the kind of, American dream experience that I was hoping for or something like that.
Yeah.
Jill, we've talked about it, with anybody, the job stayers versus job changers, and how the difference in wages, if you change job, your wages have gone up, drastically higher than if you stayed in a job. So anybody that stayed in a job, if you get a 5%, raise each year, over the past couple of years, we're up, 25% accumulation in inflation. Mm-hmm. So that purchasing power has gone down. Housing has gone up, rates have gone up, so the cost of that same house, anybody that's renting, even though those wages have gone up, what they're actually bringing home to go spend has come down. So that's, I think, part of the anecdotal evidence there is everything is more expensive, and if you haven't changed jobs or gotten a new job, you probably haven't kept up with it. So every dollar you're making is worth less than it was, obviously, a few years ago. Everything's more expensive, so again, even though nominally you're making more money, everything else is just not there for you. So, I can see why, you talk to anybody about childcare, food, housing, all of it starts to add up. And it's the stuff you see every single day and the stuff you're paying for every single day. And you're noticing, I'm going to get a salad, wait, it's $19 now, what's going on? So that it's one of those recurring things, or it's not just a kind of a one-time payment. You got a mortgage every month, you're going to get food every day, you're getting gas, every 2 weeks.
Well,
all those things are daily.
That goes into like when we're talking with issuers. You're talking about consumer and their spend, right? So you're seeing the low-income household, which has been really the recipient of the minimum wage growth, especially out in California and other areas where they've hiked it up significantly. They're trading down, or they're tightening the purse strings and doing without right now, which is very different from what that happens. That impacts a number of different consumer names and also the GDP. And then the middle income, households not getting the stimulus checks anymore. You're getting a 2 to 5% inflation raise every year, depending. Yet inflation is 26% plus over 3.5 years. You're not keeping pace. So you're actually doing more with less, and now you're trading down to where the lower income consumers up, and the high end's really spending on services and travel right now. They're not spending. So what you're seeing is, and you look at the equities that mirror those sectors, you're going to see that. Travel and leisure is doing well, right? Other stores, not so much.
Right.
So the question is, right, to Max's point and everything else we're talking about, it's a big shift of where we're going. To your point, Chris, on where the investment opportunities is, consumer seems to be in dog days right now for the next couple of
and Chris, you have to ask yourself, even if you were to get 1 or 2 rate cuts this year, is that really going to change the calculus of the housing market? Supply is the issue there. We see insurance up 22 to 25% since pre-COVID. That's not going to move the insurance needle. Same thing when you think about how companies are managing their balance sheets through higher interest rates. It's about margins. It could be passed off as inflation is higher, but this is also kind of a backdoor way to, pad your margins a bit using that inflation narrative.
Yeah. Look, I think the rates matter less than actually inflation coming down. So I think consumers, if you keep everyone employed, that'll be a positive thing. But what you really need is inflation to come back down. Auto insurance is at its highest growth rates ever right now. I actually do think you'll continue to see inflation come down. I think you'll see house prices slowly come down here. You'll see, insurance is talking about slowing from here, and I think you'll start to see that maybe benefit the consumer as we move through the year, to the extent that jobs stay positive, right?
So it almost sounds like it's a reset, right? Like this is the new normal, the environment that we're going to.
Yeah, I think the level is, hopefully they do get inflation back into that 2 to 3%, because then if you're getting 2 to 3% wage growth and everyone's employed, then everyone should start to feel okay again.
Right.
But they really need to get inflation down before they cut rates. I don't think 25 basis points of rate cuts is going to matter at all in terms of housing demand or stimulating anything.
Yeah, well, because again, the underlying issue is supply. Yeah. Right. So, 2, 3, 4 rate cuts isn't going to move the needle, but then of course you don't want to have those 6, 7, 8 rate cuts, because then we have a bigger problem. Yeah. That there are some big issues in the economy, right?
Are you cutting rates because we're entering a recession, or are you cutting rates because you want to dial everything back and let everything, as you said, reset? It's a tough question to ask.
So I wonder if the market's pricing in what's in the middle, and they're looking at, okay, corporate earnings are been good, balance sheets have been, governance has been tightened up a bit. We're able to manage balance sheets in a more proactive manner. Maybe that's how the market's thinking, and not predicating it on rate cuts.
Yeah, historically, when the Fed has to cut more than a couple of times, it's actually bad for equities.
Right.
It means something bad is going on. So I think we have to be careful.
Careful what you wish for, right? I think I'd rather have a strong economy and be employed instead of getting, making the market happen and getting a rate cut.
I mean, the market has digested. We've spoken about it a couple weeks ago. We started off the year expecting 6 cuts. Now we're at 1 to 2. If we had said that before the year, hey, we're actually going to go from 6 to 2. Do you think stocks are going to be at all-time highs? You'd probably say no, because that's what was really fueled the momentum at the end of the year. The market's digested it. I think we're okay with it. With not getting massive rate cuts, not going to make a huge difference. So again, the market has said we're okay with it. Balance sheets are stronger. They're more prepared for anything in the future. So we've been able to perform through this and not be so reliant on it. Where earlier, obviously at the end of last year, it was all about rate cuts, rate cuts, rate cuts. That's what spurred everything. Now it's okay. We're not going to get it, but markets are still here.
Right. And Michael, the economy is not the market, and the market's not the economy, right?
Yeah, exactly.
All right, guys, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.